Hi, welcome back. I've got a financial myth to talk about today. Here you go. Should, and I'll ask it as a question because that's really the best way to do it. Should a well-managed portfolio be expected to beat the market? Well, the first reaction, of course, is, well, yeah, if I'm having somebody manage my money, that's implied in the well-managed, right? If I'm having somebody manage my money, or I'm giving my money to mutual funds or whatever I'm doing, in other words, if I'm not doing it myself, or not just putting it straight into the stock market index, then yeah, I should get a better deal. I should get something for my extra money I'm spending, right? Well, I'm going to submit to you that that's a myth, or that that's an unreasonable expectation. Not that you're unreasonable for thinking that, but that is an unreasonable expectation. And here's why. There are a couple things to think about, and the first is that very often people use the stock market, the overall market, the market indices or indexes to evaluate the performance of their individual portfolio. And I'm going to tell you that I think that that can be a flawed approach. Now, I'm not saying you can't use it as a general barometer for the direction of the market. For example, if the market went up 15% in a calendar year and your portfolio went down 10%, okay, that's the kind of barometer I'm talking about. That's a major warning sign that something is way out of whack if your expectations were with the portfolio that it should track the market and that it should go, that you're being bullish. In other words, if your plan for your portfolio was to be bullish, to be expecting long-term capital appreciation from the portfolio because you're looking to the markets, then that would be bad, that your portfolio went down 10 and the market's up 15. Now, if you had been betting against the market, in other words, let's say you were shorting the market or you were buying bear market mutual funds where the very investment itself is designed to go the opposite direction, then you shouldn't be surprised. So it's always about comparing apples to apples, and we're going to get to that. But let's say that you're looking at the indexes. A lot of people will look at the Dow Jones Industrial Average. Right or wrong, we can't miss it. It's 24/7 in the news cycle, all the financial shows, radio, TV, and in the newspaper. It's there every day. Why? Well, it's one of the oldest indexes, and it's just one that everybody looks at. It's comprised of 30 stocks. They are what we call mega caps. You've got small, medium, and large companies that are domestically owned, operated out of the United States, and then you have what we call the mega caps. You can have a large cap stock that will have a $10 or so billion overall value. If you take all the stocks, multiply it by the value on a given day, that gives you what we call market capitalization or market cap. So if you take all the outstanding shares of a company and multiply it by its current market value, that gives you the total value of the enterprise, total value of that company. Well, when you do that for some of these really, really large companies we call mega caps, now some of these are in the 500, 600, 700 billion dollar range. The Apples, the Googles, the IBMs, the Exxons, all of those companies are enormous. Well, those are the types of companies that are in the Dow. Now, comparing your portfolio to a portfolio just of those stocks, I think that can be a bad comparison. All right, so let's dig a little deeper here. So besides the fact that you may be looking at an unfair comparison in terms of really it being comparable to your portfolio, you also have the fact that the returns, and that's the first thing people look at, the return comparison may not be appropriate. Why is that? Well, again, back to the point of the question being, or the myth being, a well-managed portfolio should outperform the market. So if we look at that on a return basis, which is what usually people are focused on, if you compare returns, well, you have to remember that that portfolio is doing other things besides just doing returns. What do I mean by that? Well, a well-managed portfolio is going to be diversified. If you've hired somebody to manage your money, and let's say you've hired an investment advisor to work for you in a fiduciary capacity, their job is to work for you, nobody else, not for their employer, not for a bank, brokerage firm, or insurance company. They work for you. They don't work for a mutual fund company. They work for you. And they can pick any funds they want. So they charge you 1.25% for a whole year's work. Then they also are going to use mutual funds and other investments, and let's say that the average cost of that is 0.75, 0.75%. You can add those two together. That's 2% cost of having a portfolio, the core raw material of that portfolio, and then the person managing it or the firm managing it. So think of it as you need some artwork, you need a painting done. The paint is your raw material. That's the cost of the mutual fund. So the paint costs 0.75%, and then your artist you're hiring to work with the paint and use the paints in the right combination to get what you're trying to get drawn, to get a pretty picture. That's another 1.25. So those are two distinct costs, but let's say you have that. So you've got 2% cost. And let's say the stock market, for example, in 2014, the Dow Jones was up about 7.5%. So let's say your portfolio, by contrast, was up 5%. Dow's up 7.5, you're up 5. Well, your 5 is net of those 2% fees. So if you add that back in, your portfolio would have been up 7 versus the Dow being up 7.5. So on that measure right there, did your portfolio do well? Well, the answer is yes. You say, well, wait a minute, it lagged the Dow by 2.5%. Yes, but you're comparing apples and oranges. Or a better analogy is buying a steak from a butcher and taking it home. You drive there and get it, take it home, cook some other stuff to go with it. That's going to be cheaper than, of course, going out to dinner at an upscale restaurant where they prepare the steak for you, give you the matching tablecloth to match your pants, and have roasted potatoes and a salad and all the fuss and presentation and all of that. Two totally different things. So keep that in mind when you think about returns. Now, the other thing about a well-managed portfolio, and this is really where the rubber meets the pavement. Listen to this. A well-managed portfolio, a big part of it is going to be managing risk. You have no management of risk when you buy an index. You just got it. The Dow's up, the Dow's down, there you are. Now, there's an argument and case for including indexing and exchange-traded funds and passive investing as part of an overall portfolio, and I subscribe to that. I think it's a good idea. I just don't think we put all of our money there because I think there's a strong argument, and history does indicate this is a good idea, to have a portfolio that's not just in one thing. The people that get hurt are all in one thing. Go back to 2000, 2001, 2002. The people that got hurt the most, or one of the groups of people that were hurt badly, were folks that were loaded up on technology stock. But at the time, everybody's like, why bother with asset allocation? Why bother with diversification? Just buy technology stock. So a portfolio that has cash, bonds, preferred stocks, mutual funds, no-load funds, international stocks, a whole host of different things is going to have less risk than just putting your money all in one stock market index. So by that measure, a well-managed portfolio should outperform the market, but outperforming on what basis? On a risk-adjusted or on a measure of risk basis, because you do not want your portfolio marching in lockstep just with the market. That's a dangerous game. Diversification is the key, and that will let you plan stronger.